This is Professor MoneyPigTrading. Today is March 1st, 2021. We want to talk about why buy the dips works for now and why the stock often sell off later each month since 2020. And this is Professor and a former PhD drug researcher and now a trader and data scientist. So what's going on? So we have seen SPY actually pull back at the end of each month in the last 2 days. At the end of February, actually a really big pullback. A lot of people are saying the market is going to collapse, and they think the bond market is panicking, and in fact, the stock market, a lot of bears just come out on social media. And in my personal opinion, I think the market at least should start to hold up for now. So what's going on? The bond market actually panicked, and they making the U.S. 10-year Treasury yield go up, and that's causing a lot of growth stocks, especially tech stocks, to pull back. So to begin with, we're actually not financial advisors. This presentation just education purposes. Please invest at your own risks. So what happened really is the bond market actually panicked. So when the bond actually sell off, the 10-year Treasury yield has to increase the interest rate, right? So that it will increase more people to buy bonds to balance the market. So what I've been seeing is since COVID, bond actually dropped to divided by 10 is the interest rate in this TXN 10 years Treasury yield. So divided by 10, you'll see is about 0.4% interest rate when the COVID just started. And ever since COVID started, the 10-year Treasury yield actually started to come back up to about 1.5% now. A lot of people are thinking, okay, this will make this tech bubble, stock market bubble break. But I think what they forget is the 10-year Treasury yield was actually trading a lot higher back to 2018 and 2019, when the yield was about 3.2% or 2%. And the stock market was continuously to rally back to those times. So I think that concern is not just very logical at this point. So what really happened in the bond market is they believe the reopening is on the horizon because COVID started to get controlled. So the bond market is expecting the economy is going to come back with a higher inflation. So when the inflation happens, the bond actually will sell off, because when the inflations actually get higher than the interest rate, then buying bond is losing money guaranteed, right? So like I mentioned, when the bond sold off, the yield has to increase to encourage the market to buy more bonds to balance the market. And therefore, here the yield or the interest rate will continue to increase. And when the interest rate increase, you're going to see a lot of money will start to flow from the growth stocks like Facebook, Apple into more value stocks, or that will also attract some money just like liquidate their growth stock, which has gone up quite a bit in the past 10 years. And just save the money in the bank for cash, right? Or some bond market funds, they probably need to liquidate some of their stock position to probably average down their bond position as well, since the bond has been sold off so hard. And that's why this yield increases actually create a lot of weakness in the stock market, especially on NASDAQ and tech stocks. However, my counter argument is the Federal Reserve Chairman Powell actually has been coming out, if not every month, every week, keeps saying the same thing again and again in every single of his speech. COVID is bad, employment rate is pretty high, so the inflation shouldn't be too high. And because the employment rate is so high, they want to continuously to make sure the economy to improve, the job market back to almost normal, if not completely normal. So they plan to first not to increase the interest rates, the Federal Reserve-based interest rate, at least until 2023. And if they're going to increase early, they will communicate the market early on. And also they will keep injecting money into the market. He has been saying the same thing, I don't know, in the past like 9 months. And sometimes I feel like he just talked too sophisticatedly, and too long. He should just make 2 points, 3 points, like I just said. Make it simple. Everyone will understand. The bond market will probably not panic, I hope. But I think this is the biggest argument, right? The bond market doesn't believe in him. Like, okay, we think you're lying because we think you cannot control inflation. So the interest rate will inevitably go out sooner than you said. However, I believe Federal Reserve here in this case, because Powell has built such a good team. And ever since COVID started, this chart is to show you on the left. The red is the Federal Reserve SOMA account, which means how much money they put into the account to inject the liquidity into the market. The black line is actually SPY price on the right side. You can see is the SPY price, and it's starting from August last year, 2020, all the way to February 20-ish, the end of February 24. And since this SOMA data is released by Federal Reserve every week, this is a weekly data. Same thing with SPY. You can see that ever since Federal Reserve at the beginning of COVID, they started to put more and more money into the market to hold up this market. And they say what they do, right? They are not just saying, they have been doing things, which is pretty awesome. That's why we're seeing the stock market booming, which I highly appreciate. So you can see that actually at the beginning of each month, they will increase this SOMA account balance and for 2 weeks. And the third week, they will start to decrease a little bit. And 4th week, they will reduce the account. And the new month, they will restart the cycle again. And I think that's why we're seeing, starting from September this last year, 2020, we're seeing the first 2 weeks. We're looking at January here, for example. This is a SPY chart on daily chart. The first 2 weeks, we're seeing some a pretty nice rally. The third week, just sideways consolidation. And then the 4th week, just pull back to the EMA support, which is the red line on the daily chart. And then we're seeing the same thing in February. 2 weeks rally, 3rd week's sideways consolidation, 4-week pullback. And because of this probably the most important chart in the stock market, we buy in confident at the end of January to buy the dip. And we actually got a really good return in the Moneypig trading community. This is one of my small account SPX trading. On the March 1st, I actually made 210% just by 2 SPX contract, doing pretty nice. Yeah, if you're interested in getting this chart, we're going to start posting on Twitter every Thursday. Or you can go to MoneyPigTrading.com, go to the market research tab. We'll start to put this chart every Thursday, update the chart, and we call it Federal Reserve Helicopter Money Status. So yeah, feel free to check it out on MoneyPigTrading.com. One more thing I want to highlight is March 5th, 8:30 a.m. Eastern, U.S. Eastern Time actually has an unfound payroll data. This is a key event this week. If this unfound payroll actually report larger than expected, 165,000 jobs, the bond market will start to panic again because they think the economy is doing better than expected, the inflation will go higher, blah, blah, blah. So Federal Reserve must, or very likely will, increase the interest rate sooner than expected. Therefore, the U.S. 10-year Treasury yield will start to increase. And you will see if that's the case, the U.S. stocks, especially the tech stock and NASDAQ, will start to pull back, and Philadelphia semi-index as well. However, vice versa. So this is a key event. You might want to do a little hedging on Thursday just in case this job market number doing too well and the stock market start to pull back, which is not very intuitive, but just really important to understand the concept. Just want to highlight our 2020 long-term investment program in Discord. We actually have about 40 trades, 89% winning rate, which is pretty crazy, 90% on average return per trade. We're still holding most of the positions until 2021 and doing exceptionally well. We also have swing trading Discord program. If you are busy at work, you want to do some side job trading, that's a perfect choice for you. In January, we had a really nice return, 72% winning rate over 48 option-based trading and 90% per trade, 90% return per trade. February, we have 48 swing trading again. Winning rate dropped a little bit at 62%, but return still about 47%, which is still pretty decent, and I think the members are pretty happy. If you have followed us on Twitter, make sure to follow Moneypig Trading, and like Jim Cramer shouted out our Twitter and YouTube contents, and make sure to follow Jim Cramer as well, Jim Cramer on Twitter. And if you are interested in our Discord service, feel free to follow us on www.moneypigtrading.com. Our Twitter, YouTube, and Instagram are all Moneypig Trading. Thank you for watching, and don't forget to like the video and follow us on YouTube. And see you next time. Happy trading.